Hello, ARQ clients, friends, and colleagues. This is Rich Siegel with ARQ Wealth Advisors. It is Thursday evening, May 14th, and we wanted to give a brief market update along with a discussion on the anatomy of a bear market crash. So, typically speaking, there are three phases to a bear market crash. Phase one would be the panic selling. The market did drop about 37% in 3.5 weeks. Based on the idea of a pandemic and what that might mean to the global economy. It's considered a black swan event, like we discussed in the past. We really didn't see this coming. No one really prepared for it. That includes investors, government officials, economies, etc. Characterized by incredibly high volatility, nothing really worked. Everything went down together in one fell swoop. Also characterized by a flight to safety. Investors that do not stick with the program tend to gravitate towards the safety trades of cash and U.S. Treasury bonds. Treasury bonds are actually the safest investment in the world. They cannot default. If the U.S. government cannot make good on its obligations, it will just print money and or raise taxes to do so. Phase two would be a relief rally, which we've seen a tremendous move off the bottom. You can see here that from the bottom of March 23rd through yesterday, various indices here, U.S. indices. The green is the S&P 500, the blue is the Dow Jones Industrial Average, the orange is Russell 2000 small cap stocks, and finally this purplish gray is the S&P mid cap asset class. All very tightly correlated, all up about 21 to 23% in about 6 weeks. What causes this? Fund rebalancing, for example. There are multi-billion-dollar mutual funds out there that have a mandate of, let's say, 60% stock and 40% bonds. After the market crashed, maybe they were 50-50. So they had to deploy billions of dollars to get back to their 60-40 mandate. Also, speculators that are shorting the market need to now cover their short positions, which exacerbates the rally. Opportunistic buying, firms like us, for example, we have cash for new investments by existing clients or new clients. And even though it doesn't feel right, we deploy money at these very low levels, knowing that in the future, the returns will be very strong based on those investments. FOMO, that's fear of missing out. Investors see the market going up every day, and they want in on the program, so they start to invest and chase it on the way up. You can see here that here's an index or a chart of foreign indexes. The green is the developed markets. That's primarily Europe and Japan, Australia. And then you can see the emerging markets is the blue. So these are up in the mid to high teens. The emerging markets is the BRIC countries primarily. BRIC is an acronym for Brazil, Russia, India, and China. And then finally, for charts, this is various fixed income categories. You'll notice that when the market started going up, the fear trade was not as strong. So the treasury market was relatively flat, up about 1.33% in the last 6 weeks, while corporate bonds, for example, this is investment grade corporate debt. This is not junk bonds. We're up 12% in 6 weeks. Corporate bonds have they're slightly correlated to the equity markets. Municipal bonds, the orange, up almost 8%. And then a category that we call non-traditional, they're liquid alternatives, also up about 6.5% in the last 6 weeks. So very strong across fixed income and equity categories since the March 23rd bottom. We then transition into what we call the frustration phase. Basically, the market starts to find its footing. It's looking at data now. It's looking at corporate earnings. It's looking at fundamentals of the economy, etc. It's not based on panic. It's not based on fear or emotion. It's based on actual data. And what typically happens is we start to retrace some or even all of this relief rally. It would happen in a much more orderly way. And we've noticed that the VIX, the fear indicator, has come down into the 30s. which means that the market is moving around 1 or 2% per day instead of 5 or 6% on better breadth. That should be BREADTH, breadth, meaning that not everything's moving together. There's some winners, even if the market's going down, and then on less volatility, like we just discussed. So it's our contention that the market will not retrace the entire relief rally. It's based on the unprecedented actions of the Fed and the Treasury, injecting incredible amounts of liquidity into the system to protect the credit markets, to backstop the municipalities in some cases, small business, et cetera, and the individual through higher unemployment benefits and stimulus checks. Okay, final thoughts. Businesses are beginning to reopen across the country. I know here in Arizona and Scottsdale, there's many more cars on the road than there were a few weeks ago. Businesses are reopening their doors. More cars filling up their gas tanks. We're even seeing data showing that airline travel, in some cases, are full flights. So hopefully we won't have a big resurgence, but the market is already understanding that there will be a resurgence of cases as the economy reopens. The market already understands that we're in recession. The market already understands that unemployment will hit 15 or 20%. We believe this recession should last about 3 quarters, started in February, and will probably end towards the end of the year. Other estimates are estimating shorter economic contraction of 5 or 6 months, and then I've even seen 1 or 2 years. We think that the employment picture will take longer to repair, just because when so many people are out of work, it's hard to bring them back on and ramp them up and train them. And because of the very generous unemployment benefits that are being instituted right now, many employees across the country won't be in a rush to get back to work either. Over the short term, I would say stocks are a mixed bag. There are some very cheap areas still, especially globally. Even here domestically, you'll find that banks, energy stocks are incredibly cheap relative to historical norms. And there are some areas that are probably expensive. Large cap growth stocks like Microsoft and Apple and Amazon have done quite well through this whole traumatic downturn. And their valuations are actually quite extended here. Not to say they can't go higher, but they're not cheap or even fairly valued by any stretch. So with that, stay healthy. More to come soon. Thanks for listening.